Good job.
Well, thank you. I didn't know that. I know nothing about the PFA, so it's cool that we're aligned. I'm not surprised, but it's great that that's aligned. So thanks, Cedric, for that. Nobody else? We won't make this really awkward. We'll just kind of move on. One of the things I did just want to remark as I was going through people's questionnaires. First is a really good group. I mean, I'm hoping that the next batch that I go through live up to the first batch because one, there was some really thoughtful answers there. You were really thinking on your business. It sounds like you've really put a lot of thought into your business. I will say that I saw out of, I don't remember how many I did. Let's say there was 8. Out of 8, one of you, and off the top of my head, I won't be able to pull that out. That's probably not cool anyways. One of you did a really good job of laying out your process. It's done in a brochure style. I love the fact that I had to, give you my email in order to get access to that. So nice data capture there for you to be able to retarget clients, because if somebody's coming in and checking you out and they want to see that process, they want that brochure to see your unique process, and they enter in their website for that. That's a fantastic data capture, and hopefully you have some good marketing spins around that to keep that going. So that was really cool. Some of the comments that came back in the questionnaire, I just want to reiterate that you and your process are the unique proposition that you're selling, right? I know we went through that in the first session, but I really can't stress that enough. Like there were some folks that were like, hey, we've got this process, but it kind of sounded like, hey, we'll deviate from it if we need to, right? And that just probably speaks to the fact that you could be in a stage of your business where you need to take any client that walks through the door. And I recognize the fact that cash flow is king and we need to keep that going. But you get to a point where you should have belief in what you do for clients, and you should have a process that's so good for the client that you're trying to bring in. And if you're not bringing in those clients, it's probably because you haven't done the work to really vet out that ideal client avatar, or your process does not actually speak and resonate with them. It's going to be one of those two things. But if we get to those two things, then having them come through your process and not direct you and jump around where they want to go, that should really become a cornerstone of your business and a non-negotiable. So I was listening to one of my coaches, and they were talking about the process and how it should be a non-negotiable when you're bringing somebody through, that they have to give you the A, B, C, D, E and follow the steps, because that's what is the formula for making them successful, like in achieving their goals. And so I just kind of wanted to bring that forward this morning, just because I thought, there was a really good job on these questionnaires thus far on people not just trying to answer as fast as possible. So I think that's good. I think the other interesting thing is some of you have really well-defined processes, but you don't promote them well enough on your social. So you have social, so you're doing social marketing, you're putting out info, but you're not telling people why they should care with the posts that you're doing. And two, and I go through your social and I see what are you posting, right? To see like what are you posting and who's it resonating with. So I also check on, so don't get hooked on the dopamine of somebody liking a post that you put out there. Go and see, is that somebody that actually is in my ideal audience? And are they going to buy anything from me? Because if you're getting a bunch of likes from guys like me, wholesalers, and your MGA, or your buddies from the industry, that might be a really good piece, but it's not hitting and resonating with your clients. So that piece that you spent time putting out isn't going to track back in revenue to you. So really, we've got to get our head around social marketing versus social media. Social media is where we go to hang out. Social marketing is where we're trying to drive our authentic message forward, to drive in customers to want to get to our process. So that's what I'm going to hit you on today, and that's all I'm going to go on the last. But as I said, if you want to set up an individual call, I know I've talked to some of you directly, happy to jump on an individual call. I know the next 2 weeks are going to be tight because I am writing CLU final, but we'll find time somewhere in there. So let me, without further ado, jump into the presentation. There we go. I think I have Zoom brain today because I was looking for the Zoom buttons because most of my meetings this week have been on Zoom. Okay, so second meeting. And the first meeting is designed. I don't know if I think I covered this off, but you know, the reason why we spend all that time in the first meeting talking about target audience and really trying to define that down is because when we start to layer in technical content, and I would say that from anything you learn from this point forward, so if you go to a seminar hosted by PPI and it's on travel insurance, but that's not really what you're going to be doing in your marketplace, that's kind of a waste of your time, right? Like, in fact, you should just find somebody that specializes in it, so that way you're not, you know, putting, you know, competing information or non-important information in your head that doesn't really move your game plan forward. You know, the idea is work on your business, define that avatar, and now we're going to start to structure in technical content, so that way you're thinking in their headspace of how you can bring this to them and add value for them. So hopefully that makes sense to everyone. This one actually does have some content in here. We did do our best to make sure that everything works well and that nothing is, you know, we're not using out-of-date software, and tax rates are, you know, what we know to be true tax rates. And so we're in that second phase, which is developing business. And so what we're going to go through here is we're going to talk about this business's life cycle. We're going to talk about the first thing we're going to talk about is, you know, should I pay personal, should I pay corporate? Because we know that once somebody incorporates, all of a sudden they want to pay everything through the corporation and they think it's all a write-off, right? The second thing we'll talk about is insuring corporate debts and the impact of personal guarantees. Then we're going to go into key person, and then we're going to spend the bulk of our time in shareholder agreements, right? Because first off, this is one of my favorite sessions because I love shareholder agreements. I think when we do shareholder agreements correctly, we can not only add to our centers of influence, but it typically leads to bigger sales, the estate planning sale, and it definitely cements us in potentially with their professional advisors that we're going to be playing with. So we'll spend a ton of time on that. We're going to roll 45 minutes again. We'll take a break, and then we'll come back 45 minutes, and then take a break, and then we'll come back and go the rest of the way. So I promise I will get you out of here on time. If I can do it earlier, I'll happily try and make that happen. And as with any session, folks, if you have a question, you don't have to type it into the chat. If that's where you feel most comfortable, great. But you're more than welcome to come off of mute. If you do come off of mute, you'll probably startle me just because it's quiet in my ears. So if you see that kind of stunned look, I realize I normally have that stunned look, but if you see that stunned look, it's not you, or it's just the sound coming through the headphones. So why we want to do this is, and if you remember, I don't know if anybody opened up that Kickstarter, we looked at you know, phasing or getting to know our ideal audience in their startup phase, growth phase, mature phase. And even if you don't intend to target people in their startup phase, it's important to have modeled out your client in all of these phases. So that way, when you meet them, you kind of know the pain that they've gone through. And you can also see if they didn't set some things up, and maybe they're hitting some strides in their business that's really difficult because they didn't go through or they didn't set up these sorts of things, and you can add value there. So you might be targeting the next phase, which is clients in their growth phase or clients in their mature phase. But there is value, even if you don't intend to go after newbies, understanding the growing pains and, you know, the common steps along the way that people make within that particular community. And so these are the stages we're obviously going to go through: development, growth, mature. You can look these up online. This is like, you know, I didn't invent this stuff. This is, you can go to any course and you're going to see this sort of thing. So this is what we're going to go through today. We're really not going to touch on employee benefits. We'll touch briefly on, you know, we'll touch briefly on it, but, you know, we'll touch briefly on living benefits. You know, we're really going to have mostly a high level overview of how buy-sell agreements really kind of transact, and some of the rules of thumbs around it. So that's where we're going to spend the majority of today. And then when we get into growth, that's the stuff we're going to go through, and same thing with mature. So I'm not going to spend a ton of time in there. The one thing I do want to point out in this section is we're going to meet a company today. I believe the names are Chris and Denise off the top of my head. I know the name of the company. It's Bright Mind Corporation. And so we're going to meet a business owner. We're going to take them through the startup phase or this development phase of their business. We're going to take them through the growth phase and the mature phase, and we're going to just expose some common things that we might come across and some common opportunities. So that way, when you meet your client and you have a question, you can quickly identify what phase of business they're in. And because you've done that phasing, you probably know where their headspace is. You probably know what their major worries are. You probably know the transition to that next phase of their life. So there's much more value that you can add because you've raised up your level of influence by studying these people, thus your level of leadership goes up. So let's talk about developing business and some of these things. So as I said, usually when somebody incorporates, all of a sudden they want to pay for everything corporately, don't they? Of course they do, right? And the other thing they want to know is a deductible. Those are like usually the first two things that people that are newly incorporated want to know. And in their mind, insurance is always deductible. So we have a little bit of an uphill battle that we've got to show them there. So the first thing we want to look at is, and this is what it, so if you come in traditionally to, any insurer and you say, do you have a slide that shows me something that shows the difference between paying corporately versus paying personally, right? And everybody will always get up in front of you and say, hey, it's a whole lot cheaper to pay a premium corporately than what it is personally, right? And they'll show you a slide just like this one. And this slide is not wrong, folks. It is cheaper to pay corporately than what it is personally. The big thing is early on, what you've got to have the conversation around is liquidity. Remember, with most of these business owners, and it could be in multiple phases, although it's cheaper to own it in the corporation, you got to understand what the purpose of the insurance is. And so I'm a big fan of really trying to understand somebody's liquidity position, both inside their company and outside their company, because when they're looking at personal life insurance and should they own it corporately versus personally, and they're just making the decision on tax dollars, what we forget is the story, the need for liquidity outside. And so if they're all tied up in their business and they don't have a lot of liquidity outside of their corporation, we may want to structure some of that insurance, whether it's term insurance, doesn't make a difference. We may want to structure some of that insurance outside of the corporation. Yes, it will probably cost them a bit more to do so, but the fact of the matter is we need liquidity in the potentially widow or widower's hands when they pass away. And we don't want all of that being trapped up in the company, which may be subject to creditors, right? And although we'd like to think in a perfect world, there's no delay when somebody dies, they can just flow through the capital dividend account. I can tell you that that's not always the case. And there's nothing worse than a widow that needs liquidity, to put food on the table, and we've got it all tied up into a structure that they can't get access to. So we really want to dig down to understand what they're holding and how much they're liquid outside of their corporation. And we usually try, like I'm a big fan on seeing something held outside, even though corporately it's cheaper to pay for it just because of that liquidity position. So I don't know how you folks feel about that. I don't know if that's a philosophy you follow. I know that, I can tell you that when I was with my former company, almost every presentation started out with the buy personal, buy corporate, and we were like, the presentation produced by head office would totally steamroll everything into, it makes so much more sense to own this corporately. Get the backstory and understand what's the mission we're trying to accomplish here. And so that's why, although it might make good sense from a tax perspective and financial distribution perspective to pay for it corporately, from the achieving the mission standpoint, it might make a lot more sense to hold some of that in personal name. Obviously, capital dividend account is going to be a reoccurring theme that goes on and on and on throughout all of these presentations, because honestly, capital dividend account is about the closest thing to tax wizardry, and we are the wizards, we are the Harry Potters of that story, because nobody else can do, none of the other professionals can do what we can do through the capital dividend account. What I mean by that is, not their attorney, not their accountant, not their stockbroker, not their real estate agent. People can talk to them about capital dividend. People can sell you a stock, but they can't promise you a gain which will impact your capital dividend account. The only person that can immediately impact the capital dividend account is the life insurance advisor. And the reason why is because with a stroke of a pen and some ink on some paper, we all know this story, right? We create a massive amount of liquidity that comes into a corporation, but then the Tax Act gives this big thrust forward by saying that everything over and above the adjusted cost basis on that death benefit is going to get credit to the capital dividend account. So if your client signs $1 million term premium today and they drop dead tomorrow, everything over that, I don't know, $100 is going to come out tax-free dividend account. Like, how awesome is that? And that's one of the big things that we really try to get across to people, is that not only do we bring the liquidity, but we bring the exit plan for the liquidity, right? And so quick overview of the capital dividend account. I'm not in any of my talks, I'm not trying to make you a tax professional. For some of you, this will just be just a remedial thing, but it's an important thing to go through. So what is the capital dividend account? Well, it's not a real account, and I can't tell you the amount of times I've met people that think it is. It's obviously a notional tracking account, right? And it tracks certain things, which we'll talk about in 1 second. I'm going to skip number 2, go down to number 3, which is it is an account. The notional account is tracked by the accountant. So they are tracking things like when you sell a stock, you buy it for $1, you sell it for $2. Of that dollar gain, the first 50 cents gets credit to the capital dividend account. The accountant's going to track that. Same thing with the life insurance. That's the reason why they ask us on an annual basis for what's the adjusted cost basis, what's the current death benefit, what was the premium, and was any of the NCPI deductible, right? So they want to know these things, and it's because they're tracking, or they should be tracking if they are good accountants. It is a integration tool. And so what the capital dividend account was to do was to create tax fairness, right? So tax integration, tax fairness, from the standpoint of that whether I buy the stock in personal name or I buy it in the corporation, what that first 50 cents that shouldn't be taxed on a capital gain, if I own the stock in personal name, I sell it for, if I buy it for $1, I sell it for $2, I get 50 cents tax free, I pay tax on the other 50 cents. Corporate, when I buy it for $1, I sell it for $2, the first 50 cents is tax free in the corporation, but I get that credit to my notional tracking account for that 50 cents, and thus later I can strip that out of the corporation tax free. And so I'm at no disadvantage. I haven't paid any additional taxes than what I would have had I have paid myself out a bonus or a dividend or something like that and bought that stock in personal name. So it's designed to help integrate and create some tax fairness. And there's a couple things that credit the capital dividend account, right? So first thing is sale of eligible capital property. Could be a stock, could be a building. When we get that capital gain, the first 50 cents, as we know, is tax free. So inside of a corporation, we're going to get a capital dividend on that. I'm going to skip us down to number 3, which is life insurance policies over and above the adjusted cost basis. So when we pay out $1 million, let's say it has a $10,000 cost base, $990 is going to get credit to the capital dividend account, and $10,000 will have to be paid out as a taxable dividend. But remember, they didn't have to pay a layer of tax to get that premium out in a personal name. So they're at no disadvantage with this. In fact, the advantage goes back to right here, that it doesn't cost them as much money up front in the way of tax. And when they retain tax, that extra money inside their corporation, then they have the ability to make money on that money, right? So they're not losing the lost opportunity cost that they would face with paying taxes. So it becomes a really sweet opportunity if this is disclosed and discussed correctly, not only with them, but with their professional advisors. So obviously benefits are lower tax dollars, leaving more inside the corporation. When we put money into the life insurance, we've got the liquidity use and control of that money as the cash value builds up if we're using a cash value life insurance. But either way, we're going to get access through the CDA to distribute tax-free capital dividends. And so that's one of the big advantages that we have to us. But I go back to, should I own personal, should I own corporate, really comes down to the idea of what's the mission of the insurance and what's your liquidity like inside and outside of the corporation. The other thing which doesn't go into here, which is tax deductibility. For most of us, we know, but I'm going to it bears repeating. that most insurance is life insurance is not tax deductible, right? There's very few scenarios where life insurance is tax deductible. And if you're coming across this, one of the things I talked about in last week or 2 weeks ago session was that you should have a digital package when you're meeting with people. So whatever you use, your common pieces that you use with people, you should have it in a digital format. So that way, if you leave a meeting and somebody's attached to something, you can send it to them with a quick note. And, so whatever you use physically, you should have digitally. One of the things I think you should have is a series of explanations. A lot of insurers put out explanations as to what's deductible. I have 3 of them on mine, written by Equitable Life, because we only started up our tax and estate, like our formal tax and estate division, when we brought Brian over 3 years ago. But I have one from Empire, one from Canada Life, one from, I believe, Manulife or Sun Life, one or the other. So if somebody sends me a thing saying, hey, is this premium deductible? The accountant's asking how to account for this on the balance sheet, this sort of stuff. I have that on my desktop inside my digital folder, labeled under, accounting for life insurance. I go in there, I pluck it, I email it off. We're my service is there, we're good, right? Doesn't really matter what company it represents, just that they get the info so that way the accountant can move things forward. So that's my tip on that. So let's talk about insurance for loans and personal guarantees. So loan protection, right? First off, the one thing, you're going to meet a lot of clients out there, especially in this phase, that are obviously borrowing money. It depends on the type of business it is. They may be putting up all their own capital to start it. They may be using venture cap. They may be using, there's a ton of different ways that people get money, and they may require insurance for that. So if it does, are they already in a situation where they have it insured, right? One of my LinkedIn contacts is like this guy that goes crazy over people buying bank insurance, right? And he's absolutely right. The bank insurance is kind of crap, right? I'm going to skip down to number 3. It's a blended smoker rate. It repays the loan every time you make a payment back on that loan. It decreases the amount. We all know this fun stuff. I would say the underwriting may be done at time of claim. It just depends on the size of the loan. So understand that both mortgage insurance and creditor insurance has changed with the amount that people are borrowing. When you get over, it's typically $500,000, they're going to send a paramedical out to actually check these people out up front before they go and actually bind this stuff, right? Because they don't want to have the big news splashes and stuff like that. Yes, they still sell that stuff at $500,000 and under, but they don't really want, this to happen on a $5 million claim or anything like that. First, they want their money back. That's always the case. And 2, they just don't want the bad publicity wherever they can get it. So, creditor insurance is getting better from a underwriting standpoint, but it's still the same old crap that we've been marketing against for years. So there's always a great opportunity, especially if your client is not a smoker, right? There's a good rate to save there, right? The other thing too is when we're using insurance and it's part of a deal, so it's a requirement with the lender, then the net cost of pure insurance is obviously deductible in that, right? So that's where we get into one of the deductions. So the first thing I'd say is when we get in and somebody does have a loan, first understand the details of the loan. Get to understand it, get to know who it's with, see if they've put up any personal guarantees. And you can bet at the early stages, no bank is probably just lending you on your business idea. They want you to put up the house and everything else that you can, maybe even your in-laws' house. So guarantees are important, and people will do this because they are so tunnel focused on getting the business off the ground and focusing on the things that they can control. They will sign away anything. And so if you remember in the last session, I said, one of the openers that you always hear when you go to conferences, what keeps you up at night? This is a great time when you're talking about the details of the loan. That's a good question to ask, because I guarantee you that's what probably keeps them up at night. And the other thing too is this could also be the source of arguments with spouse. Like this is the thing that really starts to compound and build. And we have a tool that takes this away, right? Like, so if you're not given the time you need, the runway you need to make this work and be successful, we have a tool that makes sure that we can wind everything up and make sure that your wife and your kids have the liquidity that you're intending to bring in, right, through your business efforts. And so that's where I would say that once we get to actually know somebody and what they're doing, this question can be a really powerful question. So let me just check on my time. I'm still going. I got a little bit more time here. So we'll dive into key person protection. I think we'll probably get through it, and then we'll spend the majority of our time, as I said, in buy-sell agreements. You know, what some of the exercise we were doing last week was to find those common things. What are the common things when we're going through our ideal prospect's business, right? So they have the right strategy. What you're going to find is if you're working within a specific sector, you're going to get to understand the sector really well, and you're going to be able to see people's twists, right? So you'll understand other companies' strategies. And then when somebody comes out and they've got that new twist on that strategy, you're gonna be able to have a lot of value with them because you're gonna be excited about what it is they're doing because you're actually gonna understand it. But two, you're gonna be able to see that they've got the right strategy or the right product or service, right? So they, let's face it, for a lot of us, we get into business, there's other people doing what we're doing, but we develop a service, which for some of you, you've mapped out, right? Your ideal service, you may have trademarked the name on that. Now it's just a matter of getting it out there, right? And to get it out there, we've got to find the right market. So who's this, who's the right people that we need to get this to? They're in no different position than what you are. The only thing cool about what we do is we have insurers that put up unlimited inventory at no, unlike car dealers, we don't have to finance that inventory, right? And the right price, right? So the cool thing is you're all brokers, so you guys can move your stuff around. But for somebody that's manufacturing a widget, they got to make sure that one, they got that right market, that right strategy, that right twist, that thing that's going to take that to the next level. But also they got to make sure that their pricing is right. And that doesn't mean they have to be cheaper than anybody. It just means that if they've solved the equation of what's going on wrong with everywhere, they can price that appropriately. But ultimately, what makes a business successful, and all of us know this, is having the right people on the bus, right? Like Jim Collins wrote Good to Great, and one of the things he talked about was, not having to have everything figured out, but having the right people on the bus to drive things forward, right? And so no difference in any business. We get to a point where we meet somebody and they might be super stressed and they might be right at that verge of needing to hire that right person. And when they hire that right person, the problem is you want to make sure that you retain that right person. And you want to make sure that when that right person actually is integrated into your business, what are the financial impacts if something were to happen to this person. And so early in a business, who are those key people? Well, it's like almost always the owner managers, right? So it could be a key individual. It could be a grouping of people that have come together. But these are people that are going to, if anything happened to them, these people have a financial impact on the success of that business. So when we can identify those people, then that creates insurable interest, right? That creates an insurable need, even if they haven't taken the time. Where we've got to, how would the business be impacted if Aaron wasn't there, right? We know that the premature death of an employee can cause a lot of things, right? In a small business, we may have it that if I'm your key employee, then I'm the person that brought the magic formula to the to the COVID calculation of the remedy, and I'm the scientist. Lenders may be a little bit gun shy on having you with money right now if anything happens to me, right? Because they might be looking and saying Brent had such highly specialized knowledge in that field, and he just passed away. We don't think this guy can make good on his loans, right? So we got to take a look at what are all the things that could happen, right? Suppliers may not extend credit. This happens a lot of times where the key people, like the manager owner, pass away early on. They may not extend credit. Customers may not return. I would say that many businesses discount the importance of their top salespeople and the impact of their business. Because for them, they're the forward-facing people, the customers that make things happen. And if one of their key salespeople goes down, you can't replace generally the top key salespeople in an organization on a one-to-one basis because they've just been doing it long enough. They know the customers well enough. They know they almost got that sixth sense of what's going to go wrong. And so if you lose one of those folks, that could spell those customers returning, and they may have had a business card right behind your top salesperson's business card saying that, if something happens to Brent, I'll give you a call and give you a try because you seem like a good guy, right? So we want to make sure that if anything happens, we have enough liquidity on hand to staff up accordingly and make sure that these folks are not going to feel any of that short-term pain of that turnover. The other big thing that happens is a lot of times employees may start to buff up the resumes to seek other employment because they doubt that the company can stay solvent without that key employee, at least in their head. They may not have any basis to really make this call, and let's face it, we live in a world of emotion a lot of times and not a world of logic. And if you're an employee, you don't typically understand how businesses are run and some of those decisions are made. So wouldn't it be a great thing if you could go out and hold a staff meeting and say, hey, we prepared for this, we've got enough liquidity on hand, and we've already thought through who our replacements would be on a senior management level, on a senior executive level. We thought through who our replacements would be. In fact, there's a company called the Executive Chair. And when they work with CEOs, what they do is they have them create what they call the executive box. And the executive box is something they keep in their office. It's for primarily small business owners. And what they do is they write down it's a lot of the stuff that, it's like a records keeper. So it's like, where do you have money? What divisions have you just looked to open? Where, who owes you money? It's things like if, you actually have to get really like real, right? And say, if anything happened to me, here's the first 3 people that I could see replacing me. Or here's the people you should contact in order to, sell the business, right? Promote this person from within. It's about the responsibility of the fact that you've tied your family's wealth up into this organization. And probably, as is with a lot of cases, the vast majority, especially early on, of your family's wealth will be tied up into this business. And so it is the responsible thing to do is to go outside of yourself, almost like a broad concept approach. I don't know if anybody's read Hal Zlotnick's book, The Broad Concept Approach, but it's the idea of having that conversation with yourself where you died yesterday, how will everything transact so that way we can extrapolate our wealth out of this asset, right? And so that's a really good thing. I'll give you one other thing with employees. So with employees, there's a brokerage in the city, an insurance brokerage that I happen to know very, very well, and very big shop. And the owner got cancer, and before they had meetings with anybody, she pulled in her second in command and turned over the banking duties and promoted them, gave them a different title, and said, you're going to deal with the bank from now on, because in their mind, they didn't want the bank seeing them go through chemo and seeing them without their hair, because in their mind, if they ever needed to borrow money in the future after they got better, that banker would always have that image in their head. So they pull in the first guy. They say, listen, we had maxed out a CI policy, so the only thing that's going to be lost here is my salary, and in fact, we're going to pay you more. We're going to promote you to this. We need duties. And then they went out and had a meeting with the staff and said, hey, we took this contingency into play. We bought the proper coverage. We're well capitalized. As a company, we're still doing really well. And I'm happy to say that this person is being promoted into this position. I'm still going to be here, but not as present as normal, right? So that's great on a CI front. I realize that can't happen on a death front. But the more that we as planners go out and meet people, have the hard questions and start to impact them by putting in contingency plans on a very real basis, the more value we add to them, the more referable we come. But ultimately, at the time when we're needed most, as opposed to having nothing but chaos, we create a serenity, a consistency that comes with certainty and control. And so this is what we bring forward to them. And you know what, we need them to start thinking about what would happen if they were no longer here. So what does the cash need, or what does the business need? What does the cash need? What does the business need? It's going to need cash, right? And it's going to need cash for a number of things, right? So immediate working cash, paying any short-term loans, interim managers, especially on the death of an individual. A key person in my mind will never be replaced on a one-to-one basis. I haven't yet to see it. And the reason why is if you're my partner, right, and you have shares in this business, if something goes wrong at 4 a.m., either you or me are getting out of bed and driving down to the shop to see what's going on, right? If you're not making your deadlines, you're probably coming in at 5 a.m. and you're probably not leaving till 7, right? You're probably coming in on weekends if it needs to be, right? Because we're fully invested in this. When we hire on a one-to-one basis with people that do not have share ownership, you are not going to get the same level of commitment. And if you think you are, you're fooling yourself. You're crazy to think that. And so understanding that sometimes you may need to hire 2-to-1 or 3-to-1 for key roles like top salespeople, like owner managers. And I love, we're going to get into partnerships, but I love corporations that have multiple owners, because it is so easy to talk about what everybody does, like what's your actual role. And what you'll find is typically somebody's more sales oriented, somebody's more creative sales oriented, and the other one's more, I don't want to say accounting, but more structured, more organizational focused. That's what makes a beautiful partnership, right? If we've got a two-pronged partnership, sometimes we have multiple partners and they bring different things to the table, but it's identifying what those things are and then talking about it on a very real basis as to how difficult that is to replace, especially when you take the motivation of not being a shareholder out of the equation. So these are the things we obviously want to talk about: hiring, interim management. How do we find, attract, hire, retain replacements? I actually just, I was on somebody's podcast the other day and we were talking about finding a, podcast doesn't come out, so don't ask me for it right now. Finding an appropriate replacement and how do you compensate them so that way you can expect the quality of work that you expected out of your partner. So, that's it's a really good discussion to have. And I tell you, a lot of these folks, they think about it in those quiet mornings and those quiet moments, but they don't often have somebody to have these discussions with them. And if you can show that you understand their business and you're really doubling down on them and you have a process, they'll open up to you and have these discussions. And these discussions lead to time, right? No person has to steal from Ben Feldman, no man has a lease on life, right? And the one thing that can derail us becoming these wildly successful to be in our business, becoming that wild success, is time. And although we can't sell them more time, if we could, geez, we'd be awesome, right? What we can sell them is the economic value replacement of what it is they're doing, right? Or covering off the taxes or giving them that liquidity that's going to be needed for key people. So at the end of the day, when we identify this, where's the money going to come from? Well, it's either going to come out of business earnings, but let's face it, business earnings may be impacted already. And when people say that, oh, it's not that big a deal, like we could fund it out of business earnings, you got to track that stuff back to $1. Like, what do you got to earn in order to cover that nut, right? And, people often think, oh, okay, well, yeah, we're in the small tax bracket, we're in the, general active rate. So that grossed up is this, great. What does that mean in sales? How much more do you have to sell in order to cover that off, right? And so that's always kind of an interesting one when you get into business earnings, that everybody comes up with this stuff off the top of their head, but people don't fully think through the answers that they provide with as to how difficult that is to come up with, right? So personal assets in the early stages of business, in the early stages of business, they're already probably pledged and used all their personal assets, right? So not so cool, right? Like, you don't have a lot of places you can go back to. They may have to then go borrow off friends and family. That sounds like fun, right? The only real success story I know that's worked out famously for, very famously for, was off the top of my head, Ted Rogers. Ted Rogers started his empire, consolidating radio stations by borrowing friends and family, having them leverage on properties and things like that. But interesting, his brother-in-law, Thomas Hull, Toby Hull, from the insurance industry, had him take out life insurance, whole life insurance, to cover all those loans, because he knew that if Ted was given the time and the runway with his passion and vision, everything would work out swimmingly and he'd pay everybody back. But if he wasn't granted that time, that the life insurance would pay everybody off. So it was a nice way to hedge that. The reason why they hedged it with life insurance, and if you read Ted Rogers' official autobiography, is later he actually leveraged on his cash value from his life insurance in order to keep consolidating and growing Rogers Communications. It's a really cool story. You could apply for bank loans, but let's face it, in this early phase of business, you've probably already tapped out bank loans, right? So there may not be a lot of that stuff unless you're going to go to like loan sharks and stuff like that. And then I would say you should really reevaluate your business. Or you may be going to angel investors and giving some of that up. But all of that comes at an expense, right? All of that comes at a cost. So, we want to make sure that if something happens to a key person, we have that cash on hand. And life insurance. Life insurance a lot of times is a very low cost tool in relation to all the other options that they have to go and get money. It's also one of those tools that, doesn't lead to awkward Thanksgiving dinners, right? When you're borrowing money from people, sometimes that can lead to some awkwardness. So life insurance becomes a nice, tidy solution for creating control, certainty, and just giving us the outcome that we really want. And I say life insurance, but folks, remember, this is also a good thing to talk about with CI. It's also a good thing to talk about with DI, because these are very real risks that we come across as well. But it's a matter of opening up the conversation, and then from there, it's a simple shift of tracks to say, hey, if that person got this, if that person got that. There's another product in the market. I forget who markets it now. I don't remember the name of the company. It used to be under Best Doctors Insurance. And effectively what it is a private OHIP. And for me, I've told a ton of business owners about it, like just saying, hey, you know what? And I usually tell the advisor when we go in on a case, like, hey, I'm going to promote this. This is what this is all about, right? And I just say to them, like, you should consider this insurance. It's effectively private OHIP. So that way, if your partner gets ill or his wife gets ill, we've got up to $5 million or $2 million, depending if we buy in a group format, of private OHIP that they can go get better. Doesn't matter if it's a new hip, if it's cancer, if it's a heart attack, if it's a valve replacement, if it's a knee replacement, doesn't really make a difference. It's effectively private OHIP. And the reason why I promote that is the faster somebody can go in and get treated and jump that queue, the likelihood of them getting back into the business and driving the profits that we all want to drive increase immeasurably, right? So I like products that do that over just things that just pay out benefits. I like things that have a story and a reason behind it. So key benefits of key person insurance obviously provides tax-free funds to cover the cost, attract, retain, make sure that employees don't buff up their resumes, make sure that there's no lost revenue over that short period of time, that we have cash on hand to shore that up, make sure that, we can meet our creditors. We can also make sure that our suppliers are happy with us. We can make sure that we keep the bank at arm's length, which who doesn't want that? So it just shows that you have put a lot of forethought into what's going on to make sure that your family and the major asset that you're tying your time and probably your assets up into have a chance to be divested and make them whole or put them ahead and make sure that they can have the lifestyle that you want them to have, and make sure that this baby that you've birthed, this company, has a chance on existing past you if something, God forbid, shuts or makes that run a little bit shorter. So good time to break, 10:48. Let's take a 5-minute here. So we'll come back at like 10:53. I'll come back probably a minute or two before that. We can open up, so I'll come off of the presentation, and then if there's questions, happy to open up for any questions. So 5 minutes, I guess now 5 minutes is 10:54. So 10:54, we'll come back and we'll rock and roll. Good stuff.
Yeah, that's great. I'm just going to remind everyone, if you haven't already, I'm going to repost the sign in link. So sign in now, and then I'll remind you at the end to sign out again.
Awesome. Go get some water, get a stretch, let the dog out, whatever you got to do. All right, so 10:54. Anybody got any questions, comments, examples, anything they want to share? given that silence, either people haven't come back or nobody's got anything to share at this point. But if you do, once again, just come off mute. I think, I think this works a lot better when we're sharing because, you guys see things, and no doubt I don't see everything, right? So, it's always a good and welcome thing to do some sharing. So let's dive back in.
Hey, Brent, quick question.
Yeah.
I have a client who has a corporation in the US and in Canada.
Okay.
So we're in the process of doing some planning for him. How complicated does that get? Is it, as long as nothing's owned by the US corporation, we're ultimately okay? Is that correct?
Yeah. So the U.S. is like it's a subsidiary, right? Like it's a division.
Yeah.
I'm assuming. What's his nationality? Like
he's Canadian. He's a Canadian resident.
He's Canadian resident, but does he have U.S. citizenship background?
No.
Okay, so that's cool, right? And he's not living in the U.S.
No, he just had to form his corporation in the U.S. to make it easier to deal with businesses. So he's got his Canadian corporation and his American one.
Right, so that it's a subsidiary, so that the planning becomes a whole lot easier then.
Okay.
It starts to get a lot more difficult when we have when they have U.S. citizenship, right? Because there's just a lot more tax structures that we've got to put in play to make sure that we keep everything on board, and then we just got to make sure that whatever we use, it's just all about the structure with that. But you don't have any of that, so you're probably very cool. Like it's probably pretty straightforward.
Okay. Perfect. Thanks.
Awesome. Oh gosh, I'm moving the presentation here, but I'm not. I gotta get out of presentation mode here. I'm not sharing yet, so give me 2 secs here. Technology at its finest. Okay, so back in we go. So shareholder agreements. This is where we're going to spend the bulk of our day, folks, and I think depending on how comfortable you are with this is really the place where you can shine. Like I love them. When I get into shareholder agreements, I just always know that if we do this well, and I'm not gonna lie, I think I do this pretty well. This is the keys to the kingdom moment usually. So, bunch of questions you want to be able to ask and go through, right? Who would own your business if anything happened to you last night? Who would take control of the business? Who would run the business, right? So those are 3 different questions, though. They sound very much like the same, right? So who would own it? Do you have, is your affairs set up in a way that your spouse can own your shares, right? Are everything going to roll over to your to your spouse? Is it going to a trust? Like, where's that going, right? In the early stages of business, they probably haven't thought this through, or they probably don't have an agreement that doesn't say that, the spouse can apply for spousal rollover, right? So that's usually a fairly easy one for us to figure out with them. However, many people just have not thought about it, right? Controlling your business, you probably think, well, my wife would get the shares, but my partner would run the business. Okay, but would the wife want to have her say? And that's the things you don't know, right? So this starts to lead to really cool conversations, right? Does your spouse, or if it's not going to your spouse, if it's going to the kids, does your spouse want to retain the business? I often at this point joke, but your spouse loves you typically, and I can't stress the word hate, like hate your business, because your business almost operates like a mistress. It's the thing that you're always thinking of. It's the thing that takes you out of the house early, home late. It's the thing that makes you leave the home on the weekend when you're supposed to be doing something else, right? It's the thing that's occupying your time and the calls on vacations that that most people don't have to take if they're just employees. So most spouses don't actually love your business. They love you. They love the lifestyle that it can provide, as long as it's providing a good lifestyle. They typically don't love your business, and they typically don't want to run your business. At the end of the day, your partner may like your wife for going out to dinner or your husband for going out to dinner, but they may not want to be in business with them. You may be very logical, they may be very emotional, right? You may have a lot of knowledge and interest, they may have none. So, both sides of the equation want probably something different than maybe what's going through that person's head, that client, that business owner's head. Do you have any plans for getting the value of your shares out of the business and into your estate? And that's an interesting one because they've probably never thought about it, right? Like I said, they borrow money, they go on guarantees, thinking about the end goal, right? Which is what they should be thinking about. They should be thinking about driving their business. That's what makes them unique, right? But at the end of the day, if something happened to them, how are they going to divest their interest from that business? Because remember, it is an investment. It starts out to be like a baby almost, like, something you've given birth to. But ultimately, it's an investment for you to live life on your own terms, drive values, and hopefully one day somebody comes in with a big check, or somewhere along the way you have the desire to want to make that an intergenerational business. But ultimately, it starts out as an investment. You've invested your life savings, your house value, everything into that business. Will your partners buy your business from you, and at what price? So if you don't have a shareholder, this starts the good talk for getting them to think towards a shareholders agreement, which their accountant or their lawyer or somebody they know has probably brought up to them before. But sometimes people think they're not at the level that it makes sense. And that level is different things for different people. I can tell you that a couple of years back, Brian and I worked on a case that had no shareholders agreement, had been running for over a decade, had a value of $5 million. And they thought that was the sort of planning you did when you had a big business, like worth more than like $10 million sort of thing. And so it's funny that, that the, I don't know what you want to call it, the stakes, the markers, the levels that people will have in their head. But what we want to do is talk to them about creating intended outcomes versus unintended consequences, right? If your partners were going to buy it and you knew the price, how are they going to pay for it? And we're going to examine all of that. So the real value here is starting to make numbers come to life and get them to see where does the money come from. And it may not be as easy as it is in your head. So what happens to the shares of a deceased shareholder if there's no prior agreement? Well, shares are probably going to pass through to the surviving spouse if they have a surviving spouse, or the children or other beneficiaries, right? And that may not be what business owners want. So what are the problems that might arise out of this? Well, there could be tension between the other shareholders, right? Because they may not like the family. They may not want to be in business with the spouse, or worse, the spouse's love interest or new husband, right? And so this happens, right? It happens more than what we'd like to say, but it does happen. The family probably just wants to divest their interest. They probably just want the other shareholders to buy their shares, right? I'd rather you take all the shares and all the risk, and we'll just take the cash because, I don't want to be in this business. Remaining shareholders, so if we don't have an agreement, we may have a family that's holding those shares and think they know the best way to drive this business forward. Or, worse, you've got some built up fantasy that Junior knows how to drive the business forward, who's never actually been in business. And the remaining shareholders may just want them out, but they just don't have the access to funds to buy them out. So, and then the last thing that happens a lot in the absence of shareholder agreements, we may end up with shareholders haggling over price, right? So they may not be able to find an agreeable price. And so, the shareholders agreement just gives us, it's a document that just gives us that agreement, obviously, that gives us all these terms, right? So in the end, just to sum it up, typically the deceased estate would prefer cash over shares. And typically the shareholders want control of the company. They want all the shares and all the control, right? So that way when they're working weekends, evenings, and everything else, they're driving for their increase in value, not to increase somebody's shares that are just kind of sitting back as shareholders. So we enter into shareholders agreement, right? It's a contractual undertaking. So these are like kind of our, thing, right? Contractual, it's a kind of our formal bit, right? Which is contractual undertaking of each of the shareholders, like the rights that each of the shareholders assume and the obligations that they have. It's put in place to obviously minimize shareholder disputes. It includes buy-sell provisions to ensure, obviously, an orderly transfer of shares in the event of a withdrawal for any reason of a shareholder. We're going to go through what those reasons are, and where possible, we want to have funding arrangements put in place to reduce that financial risk, right? And that's where obviously we come in. Like when we hear shareholder agreements, we want to know, is it funded or unfunded? Because when it's unfunded, our antenna go up. When it is funded, what we want to find out is, well, when's the last time it was reviewed, and what's happened to the value of the company since the last time you did insurance and everything, right? Because that's where our antenna goes up. So what are the triggering events? Dissension between parties. So me and you are partners. You know, I don't like something you're doing, or I want to take the company in a different direction. I go set up a division and I start to like move, you know, business over to there, away from us and over to there. So, you know, obviously deals with dissension, deals with third-party offers. And this is important not only now, so like there's different agreements that are going to come up throughout the stages, right? But third-party offers are even happen in that mature phase if we're transferring to kids, right? Because we need to know that even though I've promised this to Junior, if somebody comes in with the right checks, like, you know, we're gonna take that offer, right? And so what are we going to do during third-party offers? How are we going to evaluate it? And how's everybody going to be in agreement on it? What happens in the case of marital breakdown? I have seen some really great businesses, unfortunately, fall apart very fast because of infidelity and marital breakdown. So, you know, we want to make sure that, you know, the agreement addresses that. And pretty much every standard boiler template that a lawyer has will address this. What happens in the case of insolvency? So somebody has to go bankrupt because, you know, the business is doing okay, but they've made some really crazy moves personally, or something really bad has happened to them. You know, we want to make sure that, you know, they can't leverage those shares in any way, or put the company in any weird position. That there's a clause in there that allows us to buy and that's what shotgun clauses are about, right? So although there's a lot of people that don't really like shotgun clauses, you know, I'll tell you there's good reason for them in a shareholders agreement, and one of them is insolvency. And we'll talk about shotguns in one quick second. I don't think we have a slide on it, but I always like to mention it just so that way everybody knows the good things about shotgun and the potential pitfalls about shotgun. Obviously, retirement. We're not all going to live and want to be working for forever. And so just says how the shares are going to be redeemed over time. We may be using some sort of cash reserve on this. We may be paying people out of cash, but it just tells us how the shares are going to get redeemed over that period. And how we structure this can have a difference in taxes, right? So we want to make sure that we have it structured in a way that's beneficial for the person retiring and doesn't leave them cash strapped in that moment. Disability, critical illness. I don't see a lot of critical illness in shareholders agreements. I'm not going to lie to you. I also think that if we take a look, there's about $2.5 million of critical illness available to any one life in the Canadian market space. And I think most of us on here are seasoned advisors, been doing it for a while, that we know that most clients aren't maxing out their own personal usage of critical illness insurance, and thus they're probably not, you know, putting these things in agreements and whatnot. So there is a way to structure all of that into an agreement, and it doesn't have to be for the total amount of the agreement. So we'll talk about that when we get into one of the few, like, upcoming slides. The disability is obviously you become totally disabled, can't go into work. We want to make sure that we have some sort of benefit there to pay you out. If we don't have that, we've got to pay you out in cash, and we know the cash can be expensive. And then obviously on death, right? Something happens to a party, we want to make sure that we've got enough cash on hand to fund the share transfer between surviving shareholders and the deceased spouse, or the deceased's spouse, sorry. Think of buy-sell agreements like a prenup. Right? It's a prenup on your business. It basically is the voice of logic in a moment where there's probably going to be a lot more emotion than logic, right? And so it's an agreed upon, it's a set of agreed upon arrangements between the shareholders stating how that business is going to continue and how everybody's going to be treated on death, disability, or critical illness of a particular individual. It indicates, you know, how all the shares going to transact and who's going to have rights for ownership and that stuff. And that's really what it's all about. And obviously, just like a prenup, which is what makes that example pretty good, it's pretty tough to enforce and put things in when it's too late, right? So you've got to deal with this stuff up front. So just like a prenup, a buy-sell agreement should be done while everybody is of sound mind and healthy, because once we get into squabbling, fighting issues, death, or anything else, finding a common consensus, common ground, and in a field of logic is going to be very difficult to do, right? The objective is obviously to treat everybody fairly, but ultimately to divest the business, the interest of the business from the surviving, the spouse, and make sure that the surviving shareholders have the interest in the business. And hopefully we've done, we're trying to do this so that way we can continue the continuity of the business. So that way they're not seeing a bunch of struggles. They're not having to go line up at the bank and hope that they can get money. We're trying to make this run as smoothly as possible, because when it runs smooth, that means their mind can focus 99.9% of the time on actually running their business and generating revenues. When they've got to divert their mind, remember, this goes right back to the first session, which is the fox that chases two rabbits soon starves to death. When we are chasing too many things, when we have too many balls in the air, we let things drop and we're not as efficient. So if we could take care of this, tidy, compartmentalize, and make that move on so we could focus on running our business, then at least we know that we have a higher probability of that business being successful moving forward. There are a couple essential elements of a buy-sell agreement. So not only the agreement is important, but the valuation to determine the value of those shares is important. And it's funny, I couldn't find the book. I like to always flash your books. I'll send, when I find the title of it, I'll send it to you. There's a guy out of the States called Chris Mercer. He's a chartered business valuator. He wrote a couple, I think he's written a bunch of books on shareholder agreements. And one of them, oh gosh, what was it called? Buy-sell agreements for closely held and family business owners. And it just goes through, valuation methods. It goes through, the transfer methods and that. It's a pretty cool book to have. I remember I read it about I can't even remember how long ago, but it was a pretty good book to have. And if you're going to be dealing with folks on shareholders agreements and valuations, it's good to have some insider knowledge on how valuations kind of work, right? So that way you can raise up your level of influence with the accountant or the accounting house that may be doing the valuations. Method of financing the repurchase of the shares, that's the second essential element, right? And that's where we come in, right? Like we have, we're not going to be able to solve everything, right? Like, so obviously if somebody retires, maybe we have some cash value life insurance that can help in the repurchase of those shares. But ultimately, a lot of times in retirement, it's going to be that either one, we've sold the business and now we're flush with cash, or two, somebody out over time. So valuation, determining the value, there's a bunch of common methods, right? So valuations exclude certain assets, such as life insurance. It's recommended that it should be done by a CVV, an independent valuator, and not the client's accountant. You want to stress the use of now early on in a business where they're not really worth a lot. CVVs aren't cheap, right? But you want to use an independent valuator because you put the accountant in a very awkward position when they're the ones left to value the shares. So I like to ask the accountants, usually in advance, are you working with a CVV in this area? Because I don't want to see you end up in a legal suit, right? And a lot of times they'll be like, well, what do you mean, right? Legal suit. It's like, remember, you have a vested interest to keep the value of those shares priced low for the people buying out the spouse, right? Because, if you keep money on their books, that's good for you, right? That means you're adding value to your existing clients and you're hoping they remain existing clients. But for that spouse, if you valuate too low, you're not working in her best interest and she may sue you, and vice versa, right? So if you increase that value to a point where the surviving shareholders think that you're screwing them, you may not have a client moving forward. So it's a very awkward position to put the client's accountant. That's usually the case that they're going to be put in. But when a company starts to get into that growth phase and mature phase, they should probably be using a proper valuator for that. Then you've got to understand the different forms of valuations. Is it a fixed value? Is it a multiple of earnings? Like exactly how are we coming up with this valuation in relation to this space? And understand that every industry has its own common valuation methods. So if you do narrow down your focus, you should talk with a CVV and say, hey, have you ever valued businesses in these areas, right? And get some relationships there, because the more you can understand them, the more you're working with accountants. And if accountants aren't valuators, there's not one in-house and they're not working with one, then you can be that center of influence to introduce them over to that CVV, right? And so it's all about the value that we can add with people and making sure that they don't get themselves into places that they don't want to, taking on risks that they don't want to. In the case of the accountant, it's doing valuation. And then it comes down to methods of financing, right? So there's only so many ways that we can buy back the shares, right? So the first thing we can do is we can liquidate assets, right? And so turning bricks and steel cash is a very costly proposition, more so than what people think, right? I'm sure many of us have come across people that are real estate investors, and their idea of settling a tax bill is we'll just buy another property as opposed to buying that insurance that we don't think has a really good IRR, or that doesn't really do it for us because that's not how we've built our wealth, and they can just sell it. Well, that ignores timing. That ignores market. That ignores the fact that you understand liquidate things, but your successors may not. And so in the case of a buy-sell agreement, if we're trying to convert bricks and steel back into cash, what are we going to get on the dollar, right? So we've got something that's worth 100,000, but I'm working under duress. What do you think that my competitors or somebody's going to offer me on that particular asset? It ain't dollar for dollar, folks. So liquidating assets is a very costly way and not a very efficient way. It does not create certainty. It does not create control. It leaves us a lot of times in a bit of a lurch. We can do installments, right? So we can pay out of cash flows. You'll notice that we've got a house of cards being built over there. And that's because this is where a lot of people's heads go, but they don't track back in order, here's where you got to make the money come alive. And I'm going to give you one of my secrets, and I don't even know where I learned this one, but this is what I start to do with people. I think I learned it from Hal Zlotnick in a certain way out of his broad concept book, is that I would go through and I would kill off one of the business owners and I'd say, okay, let's go through the agreement, right? And when you're dealing with a buy-sell agreement, if there is one in place, get a copy of it. You want to be able to read it, understand it, so that way you can make the agreement come alive with folks. But what I like to do is I like to kill off one of the partners and then talk about where would the money come from. And so that's what we're doing here, is going through where would the money come from. But I love it when they say we're going to do it out of cash flows. Because when they do it out of cash flows, they probably have thought this through. So it's like, great. So as per the agreement, in the first 90 days, you have to fund 25% of the shares to, or first 60 days or whatever the contract says, right? So if your company's worth $2 million and you got to fund out $1 million of shares, you got to come up with 250,000 in 90 days. Can you do that? And you'll see them squirm and hem and haw and everything else. And that's great. Maybe we get over the first hurdle, which is the initial downstroke. But then every quarter thereafter, typically a 5-year period at some interest rate, we've got to pay out the remaining of those shares, right? And so what you've got to say is, what's that in real dollars on a quarterly basis? And then from there, you track that back into, okay, what do you got to earn, before taxes on that? And what do you got to sell? And so that's great. We might come down to that number and they may feel confident in it. But then you've got to get back to, well, okay, but Harold died, right? So you got to replace him. And so now we're going to have that talk on, is that a 1-to-1? Is that a 2-to-1? And what's that going to cost you over there? And if that's an increase in cost, or maybe it's a decrease, or maybe it's a push, where are you going to come up with the extra money that you have to come up with to fund out Harold's shares? And the cool thing is, the more shareholders we get, the better the story happens, because then you start talking about the realities. That if you hire on a one-to-one, that means you're taking on more responsibilities. Do you think that's more stress or less stress in your life? It's always more stress. What does stress lead to? Stress is distress on the body. That can lead to disease. That leads to somebody breaking down. And if something happens to you, what happens then, right? That's what leading to all this planning is about, right? But when they have multiple shareholders, this is where the cool stuff happens, the math happens. And I'll give you an exact example. Brian and I worked on this case back when I was with the previous company. We go through this, we kill off one of the business owners, we figure out the downstroke, they're cool, we're figuring out the cash flows, totally cool. And then I say, what happens if partner number 2 passes away? And they say, I think, Aaron, can you just check the folks just to make sure everybody's on mute? So I say, like, what happens if partner, so that we've got 2 partners left standing, we've funded out the first one, we're paying him on a monthly basis, they've agreed that they could handle increasing cash flow, even replacing that person. If they hired one person and they could pick up the extra duties. And I say, okay, well, what happens if Joe passes away, right? What happens if 6 months later Joe passes away? What has to happen for Joe's wife? And the guy goes, oh yeah, I got to write a check for $250,000. I go, no, that was the check for Rob, right? The check for Joe, now 50% shares, right? So that downstroke just became this. Where does that money come from? And you can kind of see they get uneasy, right? And then it's like, okay, and let's figure out what's the ongoing quarterly at the same interest rate. And then what's, how are we going to replace him? Is he a one-to-one? And you can start to see how the cards start to fall, right? Because all of a sudden, the things they never thought of, you're bringing real numbers into it. You're showing them the strain it's going to place on their business. And all of a sudden, the premium that in their heads may have seemed so big start to become a lot more palatable at that point, right? The certainty and control that it gives them, the balance and the comfort that they're going to get starts to become a lot more palatable. If you're early in a business in the startup phase, using personal assets is out of the question. In that 3-person example I was just using, that was a borderline growth mature business. They had a lot of assets, this company. But when we talked about it, we talked about what are those assets doing? And we understood the strategy of how they deployed those assets and how they were making money off those assets. Equation of using those assets and liquidating that stuff, because a lot of it was they were investing into real estate. And the problem was we go back to liquidity, right? And it's not very liquid. So the nice thing is you can when you understand where their heads are at, you can really make a thoughtful conversation around this. They could go see a scowling face like that and try and borrow the funds, but anybody that's on this line that's ever borrowed money knows that it's easier to get money out of a bank when you don't need money, right? But when you're actually in the crunch and you need money and you got to go sucking up to one of these guys, it's not always so easy. And borrowing is actually expensive money. People don't think of it that way, but when you line it up against a sinking fund, borrow the money, or buy life insurance, the highest cost alternative is borrowing, because you've got to pay that back dollar for dollar plus interest. So when you have no options, that's an option. But if you actually line these things up while we were sitting here today, healthy and logical, and said, does this make sense for us to put our money into this? We probably wouldn't take that option. Sinking funds, the other laughable one, unless you've got a client that, couldn't get the insurance, that may be a time where we may see some sort of sinking fund or some arrangement around that. But typically, business owners are going to be looking to sink their money back into their business or into the ventures that actually excites them about what they get to deploy their money into. Sinking funds are like, hey, let's put some money on the sidelines over here in cash, right? Nobody's really excited about that. That happens sometimes, but it's usually not because of this strategy. The last alternative, and obviously the one that all of us on this call want to get people to, is using life insurance proceeds. We know it's the cheapest cost alternative to all of these other options, and we know it's the only one that's instantly liquid, giving us the certainty and the control over the situation and making the most positive outcome happen. What does it do? Obviously most cost effective. It minimizes to the business. It reassures, if we got key man insurance, reinsures those creditors and suppliers, but also just having a well-funded buy-sell agreement reinsures creditors and suppliers that this business is not in trouble. And most importantly, it provides a smooth, orderly transition of the shares, divesting your spouse's interest from the business and leaving the people that should have the control and the risk associated with the business in that driver's seat. So that's the win-win we're trying to create by going through the shareholders' agreements. Upon death, we've got to look at, what are the options? Liquidation, retention, sale to surviving share. I think this was supposed to be a recap after I come back from a break, but we'll go a little bit further here and then we'll get into the actual meat of the presentation. So for liquidation, obviously we want to avoid a fire sale. I'll tell you another cool story. I'm sitting with folks that own a ton of businesses, real estate folks in Toronto, and I was trying to, make a point with them, and I said, if my wife owned the business, right, like the building right across the street from here, and I passed away tomorrow, what would you start the bidding on? Pennies on the dollar. Like, what would you give her? 100 cents on the dollar? And the guy looks at me, he goes, 40 cents on the dollar. I wasn't expecting that. I thought he'd maybe say 50 or 60. He goes right to 40 cents on the dollar is where we'd start out. And so we all know that the term estate auction doesn't mean pay full price, right? And neither does funding in a duress situation for liquidation. Retention by family, it's good, but the buy-sell agreement avoids us having all the issues that we just talked about. And ultimately, it puts that company in the hands of who should have that company, and it maintains the financial stability. I'm going to go a little bit further here. We'll talk a little bit about structures, and then we're going to go into our case study with Brightmind. Structures are important, and I don't care if you get to we're going to get to some numbers in the end. You don't have to really understand the numbers really well. If you can follow the structures, and if you can understand what a business is worth, and you can do some basic math, you can do amazing with buy-sell agreements. So there's 4 basic structures when dealing with shareholders agreements. The crisscross method, promissory, or known as the corporate crisscross, the share redemption, which I would tell you that 90+% of all agreements that you're going to come across are probably going to be share redemptions. It's probably the most commonly used one for lawyers, and there's good reason for it, right? And then there's a hybrid method, right? So, which is really just kind of a combination of promissory note or corporate crisscross and share redemption. Let's take a closer look at each of the structures. Okay. I know we've only been going for, I would normally wait a little bit on my break, but you know what? Before we dive into this case study, let's take our break now. So 11:27, let's come back at 11:32. And right now we're trending that we might finish up 5 minutes early. So let's come back and then we'll dive into the actual case study because I don't want to break awkwardly right in the middle of the case study. Cool.
That's good, Brent. I'll just remind everybody, you'll need to sign out like around 12:15-ish. So don't sign out too early. Don't sign out now, but sign out between now and when we finish, because I don't want everyone rushing to sign out at the very end in case we end up going over with questions, because the link will expire. So
good stuff. Okay, get a stretch, get some water. Let the dog out. God, looks like Aaron posted something. Oh, sorry, I'm just going back over. CBV, yep, chartered business value. So they're used to value a business, right? So if you have more questions on that, more than happy to take that one offline with you. Anybody else have any questions as we move forward? Okay, perfect. So let's dive back in then. Let me see if I can actually get rid of this screen down in the bottom, because I can't see the bottom corner, and that's always problematic. So now we're going to meet our prospect, our client. We're going to meet our example for the next couple sessions. And it's Chris and it's Denise, and they're both 38. They're both engineers, and they own a company called Brightmind Corporation. That's a software engineering firm. They are a Canadian-controlled private corporation. That's important for tax purposes, as we all well know. And they're a 3-year-old business. And so kind of looks like this. And so what we're going to look at is company profile, right? So if we took a look at the value of Brightmind Corporation, we'd see that the company's worth about $2 million. It's growing at a rate of 10%. We want to know the growth rate of businesses, folks. That sets up our service delivery model. So you'll remember that we were talking about how do we help people win? Part of it is when we know that somebody's business is growing, and we know there's different rates of growth, right? There's slow growth, there's decliners, unfortunately. There's strong growth, and then we know there's also hyper growth firms, right? And so when we know that a firm is going through strong or hyper growth, we should be seeing that firm on a much more regular basis to make sure that their funding is up to date. We should also be trying to push underwriters to a reasonable level to maybe allow them a little bit more insurance than maybe what they can validate. And the reason why is because if something happens to them, we're going to need that cash on hand. So here we've got a business growing at 10% rate. You'll see when we look into the tax examples why it's important to note that. But that's what we've got. And we've got 50-50 shareholders. And it's $1 million each. There's their cost base and paid up capital. And for the tax rates, we're looking at personal marginal rate of 50, just to keep it easy, personal marginal rate on dividends of 33, and a capital gain inclusion rate of 50%. So, that's the parameters we're working under. You don't have to send me texts and emails saying, oh, that should be this rate or that rate. Obviously, just make the adjustments in your head. Like when we work with a client, we're going to get these numbers that are actually applicable to them. So what would happen if Chris died last night? Well, is there a shareholders agreement, and does it include a mandatory buy-sell provision, right? So we have to get the agreement and read the agreement and understand what it is. Mandatory seems good as long as they have, as long as they have funding on hand. If I have a mandatory buy-sell, though, that says my wife has to sell those shares, that she's not able or entitled to hold those shares and redeem them over time, then she has to transfer those shares. Even if Denise was going to pay her out over time, she's transferred those shares, right? So she's going to have a big tax bill, but may not have the cash on hand. And this is why understanding the agreement and understanding the client's liquidity, both inside the corporation, the liquidity that comes from these agreements, and the liquidity outside of the corporation, is going to all start to come together and be that perfect trifecta of making sure that the family, stays viable, right? That they have enough cash to make their world go round. So what we're going to do is examine all the various different types of buy-sell agreements. So the first one's the crisscross method. It's the easiest method out of all of them, right? So we start out with Chris. He buys a policy on Denise, and Denise buys a policy on Chris. So hence the term crisscross, right? And that's what it looks like. And if Chris died last night, what would happen is Chris's shares would probably roll over to his spouse, right? Assuming he has a spouse. And in all these scenarios, let's just assume a spouse, so that way I don't have to explain a whole ton of different ways. But what we're going to assume is that, in his terminal return, the CRA is going to say that, Chris sold his shares the day before he died. So the value of the shares are going to be in Chris's tax return on his terminal return. But the wife is going to apply for spousal rollover provision, which is going to wipe out that immediate tax that should pop up, right? So we're going to get that, and it's going to deduct against that. So we're not going to face any tax in Chris's estate. But now his wife has the shares. So Denise at that time is going to go and file for the death benefit. She's going to do her claimant statement, get all the paperwork together with the certificates of insurance and all that fun stuff, or certificates of death and all that fun stuff. And she's going to file for the life insurance, right? So the life insurer is going to pay her $1 million in this case. What Denise is going to do is going to go to Chris's spouse and say, hey, here's $1 million. You give me the shares. I give you the $1 million. You're out of the business. I own the business, right? And so there's the transfer on At this transfer, though, now remember, his spouse is selling those shares. There was no taxation in Chris's terminal return, so now the taxation is going to happen in her hands, right? And so we're going to see in a second what that tax is. And so what are the implications here, right? So the implications are that if we had a mandatory purchase, these didn't go in her hands, so all this taxation would happen at Chris's level, by the way. So the fair market value of the shares, $1 million. The adjusted cost basis of the shares, the paid up capital, $10,000. The capital gain in this scenario, $990, right? And we're showing you this example without the capital gains exemption in place, okay? So I'm showing you this, and then I'll tell you what it would be with the capital, or I'll give you the roundabout with the capital gains exemption. We'll talk about that in a second. So 990 is the capital gain. So the first 50% we know, tax-free, right? So the first 495, completely tax-free. The second 495 on that deal is going to be taxable at 50%, right? So they're going to lose $7,000 in taxes. So Denise pays Chris's estate $1 million, and they're going to net out $752,000. So this is assuming no capital gains exemption. If, because it's a Canadian controlled private corporation, if it meets the asset test and the owners meet the residency test, so everything's cool, everything's still on board, they could have sheltered, I think it's first 882 of that 990 gain could have been deemed, could have been eligible for the capital gains exemption, meaning they wouldn't have paid tax on the first 882, meaning that they'd have paid tax on just over $100,000. So that tax bill, that after-tax proceeds, would have gone up in this particular case. It'd be very close. It'd be a lot closer to that $1 million.
Brian, we just have one question in the chat. Sorry.
Yeah, it always scares me when somebody comes on. Sorry. Go ahead.
David just asked, what forces the spouse to sell to Denise?
It depends on if it's labeled in the contract, right? So if there's no mandatory, purchase, so if there's no mandatory sale, then you're right. It may not be there, right? So there's nothing forcing them to do that. In the absence of an agreement, there wouldn't be anything to do that, right? They would have to come upon an agreed price. When we put agreement in place and we put a mandatory purchase in, it says that the shares have to be bought by Denise, and my wife has to sell those shares. It's in there. She cannot own those shares, right? You'll see some variations to that where people they'll roll over. So they call it the roll and redeem. So basically the shares will roll over to my wife and they'll redeem them over time. So where there's no insurance in place, that's probably a very good methodology, because I don't want my wife to have to sell those, deemed to sell those right away to Denise if she doesn't have the money, because then she's going to have all that taxation to pay and she won't have the cash on hand to do that, right? But in the absence of agreements, in the absence of funding, we make it work the best way we can, right? So hopefully that answers your question, but it's in the agreement that says she has to sell those shares, typically. Was that good? I'm going to take it that was fine. So
good, yep.
For Denise now owns Brightmind Corporation, lock, stock, and barrel. So she now is the 100% owner of this $2 million company. Because she bought those shares directly from Chris's wife, right, from the surviving shareholder, she gets a bump of the $1 million in her cost base. So what does that mean for her? Cost base went from 10,000 to $1,010,000. So remember, if Denise holds this business that's growing at 10%, the value of this business in 10 years from now is $5 million, 5.187, right? If she sells the business at that time, well, we know the capital gain now, instead of it being on 5,177,000, we know that we just bumped up her cost base. So she's only going to pay tax now on the $4 million of gain. Taxable portion, $2 million. She's going to pay away $1 million in tax. She's going to walk out with after-tax proceeds on this of $4.1 million. If her capital gains exemption was still in play, we'd wipe out another $882. So she would walk out with more money than what we're seeing here. So good deal for Chris's family. They had their interest divested. Great deal for Denise because she got the bump in the ACB by using the crisscross method. okay? So that what we're going to do is, and by the way, you don't have to remember all these numbers. You can if you want. There's going to be a side-by-side at the end where we're going to compare all the different numbers and talk about it and kind of say why we see what we see in the marketplace. So in summary, Chris and Denise are paying the premiums out of after-tax dollars, right? So they're paying the premiums on each policy. There can be sometimes, I'm sure it's going to come up in the disadvantages, so I'll just pull it up. The advantages, this is the simplest option. I buy on you, you buy on me, nice and simple, right? Surviving shareholders benefit by getting the bump up into the cost base, and death benefit because I own it in personal name. It's not subject to any creditors within the corporation. So we know that, as long as I pay my premiums, we know that we're probably really cool on this deal, right? Like it's simple. We know it's not going to be held up by creditors. And it's a good method for the purchaser, right? Because I'm getting that bump up in shareholder agreements. If we have multiple shareholders, doing crisscross requires a lot of policies. So that's where this methodology doesn't always hold so much water and doesn't really work so well. Yes, you can put a trust in place to own the policies, but then you've got to put a trust in place. So that's like a lot more complexity, which is why I can tell you I have never seen a crisscross method where the policies are held by a trust. Usually people go to this next option, which I'll show you in 1 second, which is the corporate crisscross. Policy management, obviously, when you have multiple policies, is difficult. The other thing, you've got, inevitably some partners are good with money and some aren't. You don't want people lapsing contracts, right? So, policy management is difficult in this. Because the owners are paying with their net after-tax premiums out of their pockets, we know that's an expensive way to pay premiums. And the other thing that happens here, although there's not a bullet point, I'm surprised, is that if, here we've got a 38 and 38 man. So, Chris is getting a bit of a price break on Denise's premium over Denise on Chris, right? Because it's life that we just looked at. But if we had a discrepancy in age and smoking status, that's where this starts to become a little bit more, tough, right? It's a bit of a disadvantage because inevitably people don't want to have to pay more premium. And typically, not in all cases, but typically the older individual that smokes is usually the one that is the, the linchpin or the key driver of the original business owner, right? So, these are all the disadvantages of things that could come up. We are going to line these things up side by side at the end on the tax stuff. So you don't, like I said, you don't have to memorize all the stuff if you don't want. So here we've got the next one, which is called the promissory note. It's also known as the corporate crisscross. So effectively what it is Brightline Corporation is going to buy a policy on Chris and they're going to buy a policy on Denise, right? So we're still 50-50 shareholders, but this is what it looks like. Brightline buys a policy on Chris and Denise. If Chris dies, those shares roll over to his spouse. Once again, no difference here, right? Denise, here's where we start to get a little bit of difference in the way it flows. Denise is going to issue a promissory note to Chris's spouse, right? I know it says estate, but I'm using his spouse because it flows a little better. So Denise is going to issue a promissory note for the $1 million to Chris's spouse. Chris's spouse is going to turn over the shares to Denise. So now she owns 100% of Brightline, right? Denise is going to go in. She owns 100% of the company. She's going to file for the death benefits, and those are going to get paid into Brightline Corporation as a tax-free death benefit, right? So that's going to come in $1 million into Brightline. That $1 million coming in is going to have an adjusted cost basis to it, right? It's not going to be zero off the start, but it's going to be something. Denise could then, and this makes sense in a promissory note method, Denise is then going to take a capital dividend for the $1 million or as much of the $1 million as possible. She's then going to, so that's her taking it out. She's then going to use those benefits, that money, to cancel the promissory note with Chris's spouse. So now Chris's spouse now has $1 million in cash. The promissory note's been canceled, and Denise has 100% of Brightline Corporation. Are identical to the crisscross method we just looked at. So we get the exact same taxation on this. we get the exact same tax bump for Denise on this. So the differential really is that, I'm just pulling it all up. From a tax perspective, premiums are not deductible by the corporation, but we're paying those on the lower corporate tax dollar. And if we had a discrepancy in ages between Chris and Denise or smoking statuses, the corporation's paying the premium, and thus it usually is not such a big issue as what it is when we do a true crisscross, which honestly, I don't see very many crisscrosses. I will be completely honest. I see some corporate crisscrosses when we get to hybrid, or not hybrid, when we get to redemption, which is the next one. That's the vast majority out there. And then we're starting to see more and more hybrid come up. So here, the death benefits are received by the corporation tax-free. A portion, or depending on how old this contract is, all of it will come out through the capital dividend account, and that gives her the money to pay off the promissory note. The advantage is a lot cheaper to pay on a corporate tax dollar. If we had multiple shareholders, we don't need as many policies because the corporation could buy one policy on each of us, so don't need as many policies. Don't have those problems related to premium disparity, and the surviving shareholder gets that bump in the ACB, so definite advantage to them. Disadvantages is that if we're holding this in the operating company, if the operating company all of a sudden has any creditors, we may not be able to just flow that money out easy, right? So this is where it kind of gets a little dicey. If we have a holding company, that could potentially get around the issues. So there's, structure becomes so important when we're dealing with corporations. And so understanding where we're owning it and the potential issues, that's where we really add our value, folks. Oh, that's weird. Oh, no, never mind. It's not weird. We already went through the tax stuff. I just flipped through it quick because it was the exact same. Sorry. Some mornings, the lights are on, but no one's home. Option number 3, the share redemption. So the share redemption is probably what you're going to see the most of out in the market space. It's one you'll see when we go through the tax stuff, probably why it's used the most, but it's also the one that it's just the one that lawyers typically, that's what their boiler templates are, share redemptions, right? So that's why you're going to come across a lot of these. So share redemption starts out looking like very close to the last one we just looked at, in that Brightmind Corp is going to buy a policy on Denise. If Chris dies last night, same thing's going to happen. His spouse, the shares are going to roll over to the spouse. Denise, the company, Brightmind, is going to go get the life insurance benefits paid in. Inside the agreement, it's probably going to say that with the valuation that the death benefits are not to be taken into consideration of the valuation of the company, right? So that's excluded from the valuation. So the benefits are going to come into Brightmind tax-free. Brightmind is going to pay out the $1 million to Chris's spouse, buying back those shares. And what they're going to do is they're going to cancel those shares. So they're going to call this what they call a redemption dividend. And so what they're going to do is they're going to buy back those shares and they're going to cancel them. So now Denise owns 100% of Brightmind Corp, but she's got the same amount of shares and she's got the same cost base, which we're going to see in a second what that means to her. The thing about this is if we pay this out, so here's where the agreement you want to make sure the agreement is not silent on this. A lot of agreements are silent when it comes to capital dividend account, especially share redemptions. And it just basically says, it just doesn't say anything about who, is the dividend that's going to be paid out, is it going to be a capital dividend or is it going to be a taxable dividend? And if I'm the surviving shareholder, Denise, if it doesn't state that I have to pay out a capital dividend, I sure the heck don't want to pay out a capital dividend because I'd rather keep that balance in that notional account so I can later strip money out of the corporation tax-free. So we want to review agreements to make sure they're not silent on that point, right? The second thing we want to look at is, and we're not going to really go deep dive into stop loss rules because we just don't have time, but sometimes when we pay out a full capital dividend, we're going to get hit with the stop loss rule. we're gonna have some taxation that we're gonna face that we didn't want to face. So it's in those solutions that we're gonna come across what's called a 50% solution. So we're gonna pay half out as a taxable dividend and half out as a capital dividend, and that's going to allow us with some loss carryback provisions. So it's when we get into this scenario, this is where you're going to want to deal with, you're going to want to deal with myself and Brian or whatever company you're dealing with, their tax and estate planner, so that way you can explain it thoroughly to the individuals and you can make sure that the agreement reflects that. So stop loss, it's because of this, this grandfathering that happened back in 1995. Sorry, let me just stop my phone from ringing and distracting me. So we just want to make sure that if it's a grandfather contract, if they have if they've grandfathered shares, if they have old life insurance policies, we've got to take into account the stop loss rules. It's not something that stops the deal going forward. It just requires a little bit more explanation around it. And so when we deal with a share redemption, Chris died, the company paid them $1 million. We've sold those shares, cost base $10,000. The initial capital gain, $990. We're going to owe taxes on $495. But we're going to have some loss carryback. So what we're going to do is the estate's going to apply for loss carryback on those shares, and we're going to get some write down on this. So we're not going to pay as much in tax as what we were on the previous example. So at the end of the day, sorry, I don't know why actually, that's really weird. I didn't notice that before. So total taxes payable are going to be 123,000, not almost 250,000, which means in a share redemption, Chris's spouse, cash in pocket, is going to end up with about what is that, 880, 875, roughly in there. So the other one was about 750. Here she ends up with about 875. And so a really good deal for Chris's spouse, but as you'll see in a second, not as good a deal for Denise. So for Denise, remember when those shares got bought back, Chris's shares got canceled, right? So it was a redemption dividend with canceling the shares. So now Denise owns a $2 million company, but it has the same $10,000 cost base. And so if we go out and we get that 10% growth and she sells the business in 10 years, we get a $5 million company, but we still now only have a $10,000 cost base. It means Denise is going to pay more in taxes. She's going to have less after-tax proceeds, because I think on the other one, it was like 4.1, almost 4.2 million bucks. And here she's going to end up with about 3.9. So Chris's family ends up with a little bit more in their pocket, and Denise ends up with a little less in their pocket. So as you can see, if I'm the surviving spouse, I like share redemption over crisscross, because, I end up with more money. I don't really care that you have to pay tax later on when you become wildly successful and rich. But however, if you're Denise, even though you like the fact that your family's going to get more money, everybody always wants to play the odds of, maybe I'm not the one that's going to die, right? Like maybe I'm the one that's going to live, and I would prefer having that bump. So this is where we don't tell clients. It's funny, as I said, I'm writing the CLU final in like a week. But it's funny that I talk about this in the course, and it's funny I found this in that course where they say we don't tell clients what to do. We counsel them on the options and talk about and help them work through and decide what's best for them. So if it was all about the math on the survivor, we'd take share redemption every day of the week. But if it's all upon the probability that you may be the survivor, you may logically today say that you want to have a corporate crisscross in place. And there's no right or wrong, but we have to have something that says why we went with this methodology when we did, like when we put it all in place. Advantages, disadvantages, fairly similar to the corporate crisscross from a premium standpoint, paid corporately. If there's any discrepancies, it really doesn't create a big problem. If we've got multiple shareholders, easier setup with the corporation owning it. Advantages are, less expensive to pay premiums, all that fun stuff. The disadvantages, you don't get the bump in the cost base. And once again, if it's held in the operating company, might be subject to creditors. So can't get around that stuff except with good structure, right? So this is where we start to talk to them about the implementation of holding companies and family trusts and all this stuff, right? It would be too early at this stage probably to be introducing freezes and family trusts and stuff like that, but it's something that when we've modeled out, this is the way things go. If you keep on this trend, this is the way we've seen other clients go. You're adding that value to them and that confidence that they've chosen the right advisor to take them through that next planning stage, right? So that's why it's important that we know how all this works.
Brent, without scaring you.
Yeah, no, I didn't this time.
While you're drinking water. We just have a couple questions in the chat.
Okay.
For some reason, my chat won't. Let's see here. So what happens when a shareholder has two wills, one for business, one personal? In the business, they choose the other shareholders as beneficiaries, is the first one.
Okay, so the dual will thing is more about probate, right? So than it is about shares. Although you know your will, you're going to name who you're leaving as the survivor or the surviving shareholder. Typically, you're going to leave it to your wife, so that way you can get the rollover provision, right? That's typically the way things go. If you don't have a spouse, then you know. Then it's probably going to your children, right? And if there's no children, then you know, then it could go to your nieces, nephews, whatever. And the agreement may state that they have to mandatory buy out those shares, right? But typically the dual will thing, which they pretty much mirror each other, is just more about a probate play, right? So you're trying not to get probated on your largest asset, which is typically your business. So hopefully that answers that question.
Then there's two other questions. The other one was, after 10 years, the ACB is the same as 10,000.
Yep. So your ACB is what you started the company with, right? So zero ACB, where you saw the other ones where they were getting the $1 million bump, it's because they were physically buying those shares and then cost basis of what you paid for those shares. So they paid $1 million for those shares. And so their cost base goes up by that $1 million, right? So that's why they would get the bump in the ACB.
And then on regarding the dual will, it would be most recently dated. Would it be the most recently dated that would override the other?
Yeah, unless of course they could prove duress on that or influence, right? So if the will was done, you know, always when you write a will, like usually the opening line, something like along the lines of this will revokes all other wills sort of thing, because it's the most recent will, right? The only time that gets problematic is if somebody's going to contest that will and argue that there's been undue influence, or that the individual had, you know, and if they can prove it, they had reduced capacity when making that will. Does that tidy that one up?
Yep, that's good. Thanks.
Okay, cool. Good questions. Great questions.
One more just came in. Is there something that you can send that breaks down each method with its importance, features, and benefits?
Yeah, I'll send everybody a copy of these slides. You know, and I'll also send you, I'll look up the name of that book because I just can't find it. I moved to offices a couple times, and so I can't find that book by Chris Mercer. But I'll look it up online, and I'll send a link to the book that I was talking to that I read a number of years back. And you know, it's a technical book because Chris is a chartered business valuator, so think accountant that values business. But it is a good book to have, right? It's a good reference piece to have, just, you know, for your own right. But the cool thing is as you come across shareholder agreements, like this is a lot of what Brian and I do, is we work with advisors where they'll get a copy of that agreement. We'll agreement with them, devise a strategy. A lot of times if there's things of issue within the agreement, Brian will write a memo for them to take with their tax advisors, because Brian, even though he's a tax lawyer, he works for the insurance company, so he gives up his right to practice. So we're not trying to scoop clients and do that work. What we do is write a memo. And I actually skipped over this, and I'll stop right now and I'll just explain it. When we get into a shareholders agreement, one of the primary things we want to do is bring their professional advisors to the table. It is the most awesome opportunity we have to show our real worth. And from that, what I mean is we're there to sell for the lawyers and accountants. And if we can sell on their behalf, then they know that they can work with us, they're less likely to try and bring in the other insurance advisors that they know. And they all know other insurance advisors, let's be honest, right? So when they don't fear that we're trying to take a client away or replace them, and they see that we're working with them and actually generating revenue, that reciprocity is going to kick in and they're going to work with you on this. And the nice thing is that when they work with you, if you have a good working relationship, I come across the same accountants, believe it or not, a fair amount in the city of Toronto. And when I do, I don't have to, build myself up. They know what they're getting and they're comfortable with us, and it sets the tone differently in the meeting. The other thing too is for those of you, because you're in this business, when you have a defined ideal market and you can work with them and sell on their behalf, you can start sending them info that would be of interest to a lawyer or an accountant or whoever it is to counsel clients on these fronts, changes that are going on. And if you can do that in a timely manner, you can start to become a trusted resource for them. And when they come across somebody, if they know your defined market and they know you're process driven and that you deliver good service, you have a high probability of actually getting referrals out of these folks. So that's the benefit of doing a really good job and helping sell on their behalf. Because let's face it, most lawyers and accountants, they're in the sales business, but they don't like to sell. So if we can sell on their behalf, we sell things like revisions of the contract, right? Because once people understand and they actually read and understand the agreement that they paid so much money for, a lot of times they don't like it or they want something different. And so if we can go back and help them sell revisions, we're making sales on their behalf. The other thing too is we get into the idea of, do you have corporate wills? Do you have business wills? Do you have multiple wills? And they say, no, we don't. And then we say to the lawyer, well, do you handle wills or is that a separate division within your firm? And they go, no, that's a separate guy within our firm. Great. We should have a meeting with him to review the actual will. And then you get a copy of the will and you explain the will to them and all that fun stuff. So you're just digging through layers and layers and layers, and it all opened up over a shareholders agreement. And a lot of times you get down to hey, the estate's going to have these estate taxes. How are we going to take care of that, right? So that's the beautiful thing about shareholders agreements. And I guarantee if you do them right, they are like dominoes that keep falling. And we all know in this business, it's not your first sale that makes you the money, but typically every time a client buys from you, you double up on what you made on the original sale. And it's so true with buy-sell agreements. So last one is the hybrid method. And it's exactly like what it sounds like. It's a little bit, what was that? I don't know that song. It's a little bit before me, but a little bit country, a little bit rock and roll. Well, it's a little bit crisscross and a little bit share redemption, right? So the same thing, Brightmind's going to buy all the policies on us. Chris is going to pass away. Shares roll over to his spouse. Here's where we get a little bit of each, right? So Denise is going to issue a promissory note for $500,000 to Chris's spouse, and she's going to transfer the shares to Denise. Why don't we have that step in here? Or maybe we do, I don't know. Sorry. Okay, so we missed that one arrow. So Denise issues promissory note to Chris's spouse. She transfers the shares to Denise. We go to the insurer. We get the death benefits into Brightmind Corporation. 50%, so $500,000 is going to be done by share redemption, and those shares are going to be by Brightmind and they're going to be canceled. And Denise is going to take her $500,000 out as a tax-free capital dividend, obviously, and she's going to pay off Chris's spouse. So what do we accomplish on this, right? So there's good good reason why we would do this. So if we have this will happen a lot where there's grandfathered shares and there's stop loss rules. We might end up with some being done as a share redemption. We might end up some being done as a crisscross, right? So just depends on what clients like and whether they can and what they can decide upon. So for Chris, for Chris's spouse here, $1 million goes to Chris's spouse. You know, ACB's 10 grand. On the first $500,000, right? We've got we're going to pay tax on $500,000 as a dividend, and then the other $500,000 we're going to pay as a capital gain. So we're going to get so we're going to have some loss carry back on one side of the shares, and on the other one we're going to have capital gains exemption, or we're going to have capital gain. This is going to result in taxes payable of $186,000. So remember that when we did the crisscross method, it was about $250,000. So this is going to lessen the tax bite for, lessens the tax bite versus a pure share redemption, but not as good as a full, lessens the tax bite on a corporate crisscross and a crisscross, but not as good as the share redemption, right? Because we're going to slide right in the middle there, because we're doing half of it as redemption, half of it as a crisscross, as we're buying the actual shares. For Denise, and I apologize, I'm getting tongue-tied. It's just been a long run here today. Denise gets $2 million in shares, and you're going to see it all line up side by side in a second. So Denise gets her $2 million in shares. Remember, she bought $500,000 for your corporate crisscross, so she gets a bump of $500,000. So later on, when she goes to sell the company, she's paying tax at $4 million, not at 3.8 on the share redemption, but not as good as the 4.1 on the total redemption, or on the crisscross, right? So let's take a look at these things side by side. I think it'll be a little easier to follow. Well, I guess first we got to go through the, similar sort of advantages from paying the premiums and discrepancy and all that stuff, and not needing multiple policies. Death benefit, it goes into the corporation. So once again, maybe subject to creditors. You need a well-written buy-sell in order to provide this flexibility. And there are times when this flexibility makes a lot of sense, especially where we've got grandfathered shares. This is the most complex option out of them all. And obviously going through and seeing it there, you would agree with me on that. The cool thing about this one is that Denise got the bump in the, cost base, right? She paid out a tax-free capital she paid out a tax-free capital dividend to herself to redeem those. We still need to make sure that the agreement is not silent as to whether that dividend was a taxable dividend or a tax-free capital dividend. So this is a much more complicated method that we're going through, and we need to make sure that everybody understands the advantages, disadvantages. So let's take a look at the side by side. So this is for really Chris's spouse, right? In every scenario, they're getting a check for $1 million. It just comes down to what are they going to net in this check, right? So if I'm Chris's spouse, we can all pretty much guess which method I would prefer. Am I right? It's number 3. It's the share redemption. It results in the least amount of tax for me. I end up with about $880, roughly $875, right? The hybrid is the second best for me. I end up with, what is that, $815 roughly, right? The promissory and the crisscross are not the best for me. So why would we ever go to those first two? Well, remember, if Chris thinks, I think I'm going to outlive Denise, and this could be a benefit to me in the future if I sell the business, and vice versa, if we were both thinking logically about that, we might go to that. Now, here's the reason why we don't put somebody under the gun or tell them what method. We never tell them which method they should choose, because we don't, when the spouse says, why did you choose this method? My lawyer says I would have done better under that. We have notes in our files to say we presented all the options. This was the option that they decided was best for them. From Denise's perspective, the crisscross and the promissory note are the best in her position because it gives her that bump up in ACB, right? The share redemption is actually the worst. It results in the most amount of tax for, and the hybrid sits right in the middle of it. So if I'm Denise, I want option 1 or 2. If I'm Chris's spouse, I want option 3. And depending on how we feel about things, we may end up with the hybrid, right? No right or wrong in any of this. And honestly, I'm cool with whatever one they choose as long as they fund it. And then what we can look at is, do they need personal insurance to make up any of the shortfall that's going to happen in taxes, right? Because that's an insurable need, right? So lots of opportunities here for us to do what we do best, which is counsel and sell insurance. And ultimately, I'm sure we'd all be happy if we were selling, very large insurance policies. Nice summary on the taxes. I'll send this out to everybody. There's it all on one page. Total taxes payable under the redemption are the highest, but once again, if I'm Chris's spouse, I don't care that Denise has to pay more taxes, right? So, that's where the advantages, the advantages kind of get lost in the other ones if I don't care about it. The hybrid actually ends up in a pretty good position too. So in summary, there's no one size fits all for this, right? There's no one option is right for every client. What you will do, and anybody that's on the call, maybe once we come off, go back to camera, everybody can come off, and if anybody wants to share, and maybe you can agree with me or tell me I'm dead wrong. But I would bet that most of you that have ever done a shareholders agreement, it was probably a share redemption. So maybe we can open up and ask about that, but you're going to come across that because that's the boiler template for most lawyers. So, and they make some small adjustments off of it, but that's usually what people are getting. So understanding the different options allows us to have a discussion and share with them how the flow works and the advantages, disadvantages. Ultimately, we want to be working with all of the people. We want to work macro, right? So we want to work with all of their advisors and go through each benefit and see what fits them best. We're not telling them which way to go. We're just counseling them on the available options. So let me come off of this and go back into camera. And then from there, if people want to come back on camera now, if you didn't do your hair, I completely understand. But maybe you can, you can talk about, maybe somebody can come off of mute and tell me what they're seeing. Are you mainly seeing shareholder or share redemptions? And then I'll also read the stuff in the.
Okay, I was just going to say there's some stuff in the chat there.
So Holdco Shields does not block, right? Do you maybe just want to explain that one to me, what you're asking there? So typically we're buying the opco, we're not buying the holdco, right? So, but we may have the insurance in the holdco, or there may be a common holding company. It was in response. Oh, okay. So yeah, I mean, once we know the structure, and so that goes back to the session from 2 weeks ago. Once we know the flow chart of the corporation, we can then counsel them on the best place to hold that insurance. Oh, okay. Sorry, it was down. I got you. Yeah, we can have a chat on that at some point this afternoon. I got a few phone calls, but we can find some time there if you want to have a discussion on that.
Hey, Brent, can I ask a quick question through audio, if that's okay?
Yeah, no, that's
yeah?
I welcome it. Yeah.
Perfect. It's Andrew from Canada Life. So I've been doing a lot of reading and stuff on family trusts and everything, trying to educate myself on it. Mm-hmm. Is there any benefit if shareholders were to flow any shares through like a family trust, and then that way have kind of the money a little bit, or sorry, the shares a little bit more protected, being able to be bought out a little bit more efficiently? Is there any benefit to using family trusts with any of these situations, or no?
So a lot of the reason why we won't see it so much in the startup phase, and we'll talk a little bit more in the next phase, right? But when a company starts to get into that phase where their company's growing and they're getting a lot of wealth, it's not uncommon for them to do an estate freeze and implement, a capital corp and a family trust to own those shares, or a family trust and a capital corp on the other side. There's lots of different ways to structure things. But one of the main reasons why, so one of the old reasons why we would structure in a family trust was to sprinkle dividends out to everybody. That got shut down with the TOSI rules, but there's still very good reason why we would set up a family trust to own those shares. And that is because when let's say I have 5 kids, which I don't, but let's say I did, I would name my wife and those 5 kids, and we could multiply the capital gains exemption over those 6 individuals, right? Because they would be the beneficiaries of the trust and the shareholders of the common shares. I would have froze my shares and probably taken back pref shares. I could have given myself a share of the common shares. So a lot of different ways we can structure that, but one of the main benefits is that we can multiply the capital gains exemption, thus reducing the future tax bite, especially in companies that we know are having strong growth or hyper growth into the future.
That's great information. Thank you. Is there any, do you have like any material on that I can kind of read a little bit more on what you were explaining, or?
Yeah, but we probably have something on it. I mean,
Okay.
I don't know if you're a member of Advocates and you are chasing down your CLU, but if you are, there's very good overview of that in the CLU program. But I mean, if you're not chasing that down right now, that's a whole lot of work to get to that point. So let me see if Brian has anything out there, and we can see what we can get our hands on for you.
Okay, thanks.
My pleasure. Okay, so I'm not seeing anything in the chat. I'm not seeing anybody coming off. So either everybody's multitasking, or your cups are full and you're ready to go. So that's all I have for today. So I'm happy to say, yeah, there I got the thumbs up from someone, which is great. So folks, listen, I just gave you back 9 minutes of your life. Go use that wisely. And Aaron, I'll turn it over to you, but I'm good, and we'll send out a copy of these slides to everybody shortly.
Actually, I'll just interject for a moment to say thank you very much. We very much appreciate it. On behalf of Financial Horizons, we want to thank the Equitable team for making these resources available, and Brent, thank you for sharing your knowledge with us. We very much appreciate it.
That's awesome. Thank you.
Thanks everyone for joining today. A reminder to go back in and sign out for your CEs. I have submitted the first round of CEs, so usually the team has them back within sort of 7 days. I just submitted them this week, so you should see those, but you will get them, so don't worry about that. And today's recording was successful. I see that. Last time I wasn't sure, but it did end up working. So I will send this recording out as well, and some of the resources that people have asked for, we'll push them out as we get our hands on them as well.
What's PDU?
That is the Quebec.
Okay.
I will have to double check about that.
Thank you, Erin. Yeah, it's because we need a different CE for Quebec license, so gotcha. It's not easy to get. So any PDU that we get are priceless.
Okay.
Yes, as a board member of Advocates, I know all about PDU, so I'll double check for you. So thanks everybody for joining us today, and as per usual, reach out anytime with questions. We're happy to help.
Great. Aaron, I'll leave you maybe to connect with, I forget who it was. Somebody said they wanted to maybe connect something up this afternoon. I don't know if they have my direct info, but if you could send them that would be great. And then, maybe they can just text me and we'll try and figure out a time.
Okay, sounds good.
Okay.
Okay, thanks everyone.
Awesome. Thank you. Ciao. Bye.
Bye.